The spillovers from US monetary policy. We are now 10 years on from the start of the crisis. The global financial crisis, which was substantially contributed to by different imbalances, the growth of a great deal of leverage, both at the household level, household debt in developed markets rising to very high levels, concerns about the debt that financial institutions had taken on, and we have since that crisis seen a necessary process of deleveraging across many of the developed markets. This has also been accompanied by the adoption of unconventional monetary policy by the world's largest central banks. We have seen quantitative easing, central banks pumping money out into the economies to try to stimulate growth again. And for a while, it did look as though it would take a great deal of attempts to try to get growth going after the global financial crisis. While we have seen this process of deleveraging across developed markets, in emerging markets, there's actually been a process of adding to debt. It isn't the case, 10 years on from the global financial crisis, that global debt levels have not been growing. They have been growing, substantially contributed to by the actions of different emerging economies. It's partly been the consequence of what was happening on the global level with the quantitative easing and the spillover effects of that policy. So today we'll look at concerns around the growth of leverage in the Chinese economy, expectations that debt to GDP could reach 270% in the medium term. We'll look at countries like Malaysia that had benefited from the receipt of a great deal of capital inflows in the post-crisis environment, where household debt service levels in that economy now rival what was seen in the US economy in 2006. Who would have thought? Clearly, we are looking at a new range of imbalances, and the removal of the policy accommodation, a rather blunt instrument, but one that is judged to have been successful in bringing the global economy out of the crisis that had impacted it back in 2007-2008. This is going to bring about a lot of new challenges. We need to take into account the growth in the size of central bank balance sheets. If we look at the major central banks in the world, their balance sheets have grown almost fourfold since the financial crisis. We're looking at a total balance sheet size of around $15 trillion. The understanding is that when it comes to the debt issued by the different major economies, the different developed markets globally, central banks probably hold at least 1/5 of all of the debt issued by those governments. This helps to place in context when Ghana is told that the Bank of Ghana, for reasons of macro stability, shouldn't be involved in the financing of the government deficit of all. Different considerations may apply. But what we're here to talk about today is the impact that this stimulus has had on different developing economies. If we look at what has happened globally, we know that the provision of this extraordinary amount of liquidity has played a great role in dampening volatility on a global basis. Today, we're looking at what seems to be a relatively bright situation. Growth in the developed economies is recovering. Inflation isn't yet a problem. Volatility in financial markets is very low. This has led to the perception that any removal of this policy accommodation can be very gradual. It can be signalled well in advance. It doesn't need to be a disruptive process. It can be done without causing great risks to anyone. The question we need to ask ourselves is whether this is really so. Let's look at the impact on African economies. We know that we have come out of a period of incredibly benign policy making on a global level. financial crisis. There was a new consensus post-crisis that it was okay to put in place counter-cyclical fiscal policy, that deficits could expand. There was tolerance, perhaps too much tolerance, of the greater fiscal deficits that we were seeing within Africa. Different governments were not really held accountable for the size of those deficits, simply because global financial conditions were as accommodative as they were. Investors were accommodating of these deficits, and the financing of those deficits didn't tend to cause great problems. We know that many African sovereigns understandably chose these conditions, these incredibly benign global conditions, to issue more external debt. Around the time that we were seeing QE3, we started to see a record amount of external debt issuance from African sovereigns. It became very cheap to borrow in dollars. It was especially cheap to borrow long-term. Different countries in Africa were grappling with significant infrastructure deficits. Those deficits had been years in the making. Why not use these globally very accommodative conditions to try to do something to boost infrastructure, to put in place the building blocks for more sustainable growth, it was hoped, in the future? Well, the flip side to all of this is that Africa faces a concentration of external debt maturities. If we fast forward 10 years on from that period when we were seeing record amounts of external debt issuance from African sovereigns, record amounts of Eurobond issuance, it was cheap to finance what governments were doing globally, and so they did. The problem is, come 2022, 2024, many different sovereigns in Africa are going to have to contend with these unusually large debt maturities. And this may cause problems. So far, with the exceptions of some economies, Mozambique, for very specific reasons, after the discovery of the so-called hidden debts, the Republic of Congo, again, for very specific reasons, most African sovereigns have not had trouble paying the coupon payments on their external debt. But the very fact that there is such a large amount of external debt maturities that are approaching has raised all sorts of questions about how African governments are going to deal with this. In an ideal world, markets, international capital markets, would still be open to African issuance. It would be relatively easy to refinance any maturing debt. In an ideal world, governments shouldn't be waiting until 2022, 2023 necessarily. The refinancing of that maturing debt should be taking place now. But the problem is, we face a great deal of uncertainty. For now, financial markets seem very benign. Conditions are almost too calm. Vol, measures of volatility as we see it, are at an all-time low. Many commentators have said, isn't this how crises start? Isn't this the calm before you get the eventual storm? Can you really take on that level of leverage, that growth of debt that we have seen across emerging markets, and hope that this is going to have a smooth outcome? What does more need to be done? Well, what are the consequences of this? Africa as a region, we think, is going to be particularly disadvantaged when it comes to any tightening of global financial conditions. A tightening that we know we must see at some point, but it hasn't yet manifested itself in any meaningful way. And the problem is, for as long as risk appetite stays strong, investors are not really discriminating between different quality of credits. Some assets are starting to look overvalued. Investors are willing to pour more and more money into smaller emerging markets and frontier markets. It's very easy to get a sense of complacency that these good times might continue. In Africa, however, we know that the real economic slowdown had preceded this tightening of global financial conditions by some years. This is the problem. Should we get a more meaningful tightening that's still on its way? The growth narrative in Africa has changed a great deal. We know that a few years ago, everyone was talking about Africa rising. The perception was that economies could grow, they could achieve 7% type growth rates. That very special rate of growth, which is sustained for a decade, will allow an economy to double in size over 10 years. The thinking was that this could almost be done on autopilot. Benign global conditions, investors willing to finance, the investment that needed to be put in place, the record receipts of capital inflows, the sound foundations looking at demographics, the spread of financial inclusion, good building blocks for future growth, rapid urbanization, productivity gains as people moved from rural-related functions to urban-related functions, and African economies were just going to grow in a smooth path. Now we know, since the onset of the commodity price decline in 2014, that things are not necessarily that simple. At Standard Chartered, we keep pointing out that if you look at median growth in Africa, it is nowhere near as weak as the average growth numbers for the region suggest. The problem is that that average is disproportionately influenced by Africa's big economies. South Africa and Nigeria, between them, account for over 50% of sub-Saharan African GDP. So when the South African economy grows only 0.3% in 2016, and the Nigerian economy experiences an outright contraction, the growth narrative for all of Africa changes. Suddenly everyone starts pointing to the weakest growth that the region has seen since the global financial crisis. Now, why should this come as a warning signal? The problem is that whilst other emerging markets are still seeing fairly healthy rates of growth, the narrative around economic growth in Africa, rightly or wrongly, more wrongly in our view, has changed very significantly. The investor pessimism has already started because of the decline in commodity prices. And we mention this simply because in looking to this incredible challenge facing the world's major central banks, the need to remove this enormous amount of policy stimulus that they have put in place since the global financial crisis. Can anyone do it smoothly? Can anyone do it without causing any really disruptive behavior? Will emerging market growth survive unscathed this tightening of global financial conditions, given that emerging markets are now that much more leveraged than they were 10 years ago? Who really knows? The disadvantage and the challenge facing a lot of African countries, Ghana included, is that the narrative of growth for the region has already turned around. Some level of investor pessimism is felt, even though it's not yet reflected in any meaningful way in the way financial markets have actually performed. So what is a country like Ghana to do? We know from the Q1 GDP data that growth in Ghana is picking up. Some would say it's a little bit discomforting that so much of it is based on oil and gas related developments so far, but Ghana is seeing the benefits of earlier policy decisions. The absence of central bank financing of the deficit has played a significant role in helping to bring inflation down to more sustainable levels. Just this morning, we heard from the President about the need to institutionalize fiscal rules. Ghana looking to institutionalize a fiscal rule that will cap the deficit at around 3 to 5% of GDP. And this is a good thing from the perspective that it will help bring inflation down. Interest rate easing has already started. Ghana is in a very fortunate space in that it stands to see a medium-term cycle of considerable interest rate cuts to come, which will over time, with a strengthened banking system, help to boost private sector credit growth. But we know that there are going to be challenges. crisis right there. It was easy to borrow, markets were generally accommodative of larger fiscal deficits, Ghana's deficits were large, Ghana used to be reliant on extremely short-term financing of its deficit, and those debt-to-GDP ratio, that debt-to-GDP ratio has risen to a very high level. So knowing that there's going to be a change in global financial circumstances, in the environment, knowing that Ghana and other developing countries should anticipate a meaningful tightening of global financial conditions, what should be done? In looking at the debt-to-GDP ratio, there are a number of different things that people suggest. The first one is, don't forget GDP. Growth matters. The more you can grow the denominator in that public debt ratio, GDP, the easier it will be to bring down debt to GDP overall. We think that Ghana is on track to do this. Our analysis suggests that it stands out amongst peer economies with the kind of growth rate that will be achievable if reforms unlocking private sector growth are sustained. So there is reason to be hopeful. The other aspect would be better management of the debt burden that does exist. And this is where Ghana has made great strides over the last year or so, where we have seen Ghana moving decisively away from this dependence on very short-term financing of the deficit, the issuance of very short-term instruments. Ghana has successfully issued 15-year debt, 10-year debt, 7-year debt, 5-year debt. This is important, and the effort should continue. No one can say for sure that the removal of the extensive policy accommodation that we've seen is going to go smoothly. At the end of August, we will see the Jackson Hole Conference where global central bankers get together, and because inflation is weak, the expectation is that they will signal that this is something that can still take time. The Fed may proceed with the reduction of its own balance sheet as soon as September. Markets are almost anticipating this, almost pricing it in. It hasn't caused any disruption yet. But for countries like Ghana, in sight of something that is so positive, in sight of this structural lift to growth, it's all important to ensure that it is well prepared to meet the challenges. Ghana has done very well in and of its own accord, but any tightening of global financial conditions could lead to a meaningful difference in investor behavior. In the years before the financial crisis, we know that the kind of investors, the kind of portfolio investors who got involved in African markets were typically leveraged. They were the hedge funds. They were the ones who could be more experimental. They borrowed to be able to invest in rapidly growing African economies. But this created new dangers. When the crisis hit, any idea that people had that African markets was somehow not correlated with global markets flew out the window. The crisis was severe. The redemption pressures on these leveraged funds were so severe that they had to liquidate almost anything that they had, even in small, relatively illiquid markets. And this created huge disruption in African markets as well. It took a long time, even after the onset of quantitative easing, for the appetite for investments in Africa to return. We should not forget how hard-won that was. And the good news is that in the post-crisis environment, we've seen a different kind of global investor getting more involved in Africa. Much more prevalence of real money funds, so-called real money funds that run pension assets, that manage pension money. They are supposed to have a longer-term horizon. They look at countries where there are transformative stories, where good things are happening over the medium term. This is good, but for a country like Ghana, it does not take away from the fact that more needs to be done to develop the domestic market, more should be done to develop the domestic institutional investor base. So to conclude, where are we now? was going to come back that easily. The world was awash with liquidity, and in some respects this helped to mask some of the more damaging aspects of the crisis. Central banks used the only tool that they could. The ability to use fiscal policy, that very soon ran dry. Central banks were the only game in town. And the provision of that liquidity has helped. But it's also created new challenges. No one should think that the benign environment that we've had in place signals any kind of normal. It cannot last indefinitely, but the countries that anticipate change, the countries that prepare themselves for that eventual tightening of global financial conditions are going to be in a better situation and better off when those challenges eventually manifest themselves. So Ghana has done well and should be congratulated. We're here to celebrate the 60th anniversary of the Bank of Ghana. It's one of the leading central banks in Africa, one of the first to adopt any kind of formal autonomy. These are all good developments that should be celebrated. And it's in looking to the challenges that lie ahead that we should all realise why it's so important to institutionalise these reforms. Thank you for your time.